there's a massive debate taking place internationally, and that's to do with the relevance of the 60-40 bond equity allocation. Talk to us about that.
Well, let's start with first principles. The 60-40 portfolio is one where traditionally you allocate 60% of your allocation to equities and you have 40% to fixed income. What has been interesting over the last couple of years is the relevance or usefulness of that portfolio allocation within the developed market world. As you know, interest rates are low, so therefore should you be allocating 40% of your portfolio in fixed income given where rates are at this juncture? So we thought it would be useful to actually run a similar exercise in the context of Africa. Of course, we don't suffer with negative real yields, but I think it's still important to have an understanding of pension funds, for example, if they want to have a pure African exposure in a balanced fund kind of way. What were the results of the 60-40 allocation over the last couple of years? And what we've noticed is that, well, that portfolio hasn't really gone anywhere, simply because equities have been flat over the last couple of years. And I'll get into some of those dynamics. But I think the key consideration at this point is how do you play Africa within the allocation of local currency investments, hard currency investments, and also equities. And what we've done is ask ourselves a very simple question. If you wanted to maximize your risk-adjusted returns in Africa, what would be the most optimal allocation? And what we noticed is that it would be 74% hard currency and 26% local currency and zero equities. So in that particular environment, we then have to ask ourselves, if we are placing such a huge emphasis on the hard currency space, well, what are the top picks? And in my view, we see Egypt as a very good country from a fundamental perspective. Senegal, Cote d'Ivoire are going to be interesting ones. And Ghana, obviously, as we get out of the election, I think investors will start looking at some of these environments as good ways actually getting exposure to the rest of the continent.
I'm just going to pause you there. So you've managed to optimally allocate your portfolio, right? And it's pretty much a fixed income portfolio. And you've got such a significant exposure to hard currency. I'll ask the simple question that everyone's wondering, why? What have they done over this past few years that has been such a big differentiator compared to most of your other asset classes? And do we still have the same expectation post-COVID?
Well, the interesting thing about the hard currency space is that it offers you significant liquidity. So the trading volumes on a day-to-day basis allow for bigger pension funds or hedge funds that are either sitting in South Africa or in the US and the UK to be able to actually play these markets. So I think the sheer size of that particular asset class is relatively good. And you're trading in dollars. So if you're taking exposure in dollars, you're effectively not taking a huge currency risk at this juncture. Which is juxtaposed in some way with local currency investments. I mean, the key is in the local currency investment bit, where you then have to take on, FX risk within the context of Africa. And the interesting thing about Africa, when you look at local currency investments, is that they're not as liquid, and you have to place significant emphasis on risk management, given the jump conditions that we tend to see locally when it comes to FX environments within Africa.
So on that point, I mean, over the past few years, have you seen interest specifically for local currency? I know you've mentioned that there is the currency risk, but are you finding international investors actually keen on participating in the local bonds across the various jurisdictions in Africa? And do you have top picks?
Well, certainly, yes. I mean, if we look at 2019 and 2020, I mean, it's a tale of two cities. In 2019, we were particularly excited about countries such as Nigeria and Egypt, and they're doing all the right things to actually attract inflows. And Nigeria, for example, the Naira was well supported with the inflows that we're seeing out of the developed market world. And then, of course, come 2020, everything has been turned on its head. Fortunately, Egypt is still doing relatively okay, and we're seeing inflows into the local currency bond market. Not so much in Nigeria because of the FX and local market liquidity dynamics that are keeping investors on the sidelines. As we get into 2021, I think the emphasis is again going to be on search for yield. Are we going to see investors getting excited about local currency investments? I think so. But I think the key here is going to be around differentiation, right? Not all local currency markets were created the same. So there are a few options. I think Egypt is going to be a very good one. Nigeria is a cause for concern for us, given the FX and the liquidity dynamics that we're seeing in country. Zambia is a cause for concern given the fiscal conditions. I won't tell you about that. I think you know the issues there. And of course, some of the FX losses that you could potentially experience there. We do like Kenya because it's one of those sleeping giants where the carry is not as great as a Ghana, for example, but you do get a relative stability within the currency itself compared to some of the other jurisdictions. So there are a few picks that we can take from there, and a few ones that are sort of keeping us up at night.